Hi, welcome to Government Accounting and Accounting for Nonprofit Organizations. Please watch and learn.
Revenue is the gross inflow of economic benefits or service potential during the reporting period when those inflows result in an increase in net assets equity, other than increases relating to contributions from owners. Revenue includes only those that are received or receivable by the entity in its own account. Examples of revenues are sale of goods or supply of services, used by other entity of assets yielding interest, royalties and dividends or similar distributions and other receipts. Revenue funds, on the other hand, comprise of all funds derived from the income of any agency of the government and available for appropriation or expenditure in accordance with the law. We have two sources of revenues. 1. Exchange transactions or reciprocal transfers. Exchange transactions are transactions in which one entity receives assets or services, or has liabilities extinguished, and directly gives approximately equal value, primarily in the form of cash, goods, services, or use of assets, to another entity in exchange. 2. Non-exchange transactions or NON reciprocal transactions. Non-exchange transactions are transactions in which an entity either receives value from another entity without directly giving approximately equal value in exchange, or gives value to another entity without directly receiving approximately equal value in exchange. For example, tax revenue, fines and penalties and donations. Recognition and measurement of revenue from exchange transactions. PPSAS 23 paragraph 10 provides that in a transaction where the entity may provide some considerations directly in return for the resources received, but that consideration does not approximate the fair value of the resources received, the entity determines whether there is a combination of exchange and non-exchange transactions, each component of which is recognized separately. However, there are transactions where it is not immediately clear whether they are an exchange or a non-exchange transaction. In these cases, an examination of the substance of the transaction will determine if they are an exchange or non-exchange transactions. For example, the sale of goods is normally classified as an exchange transaction. If, however, the transaction is conducted at a subsidized price, that is, a price that is not approximately equal to the fair value of the goods sold, that transaction falls within the definition of a non-exchange transaction. 1. Sale of goods. Revenue from the sale of goods shall be recognized when all of the following conditions have been satisfied. The entity has transferred to the purchaser the significant risks and rewards of ownership of the goods. The entity retains neither continuing managerial involvement to the degree usually associated with ownership nor effective control over the goods sold. The amount of revenue can be measured reliably. It is probable that the economic benefits or service potential associated with the transaction will flow to the entity, and the costs incurred can be measured reliably. 2. Supply of services. Revenue from the supply of services shall be recognized on a straight-line basis over the specified period of the services unless an alternative method better represents the stage of completion of the transaction. The recognition of revenue by reference to the stage of completion of a transaction is often referred to as the percentage of completion method. Under this method, revenue is recognized in the reporting periods in which the services are rendered. When the outcome of a transaction involving the rendering of services can be estimated reliably, revenue associated with the transaction shall be recognized by reference to the stage of completion of the transaction at the reporting date. The outcome of a transaction can be estimated reliably when all of the following conditions are satisfied. When the outcome of the transaction involving the rendering of services cannot be estimated reliably, revenue should be recognized only to the extent of the expenses recognized that are recoverable. During the early stages of a transaction, it is often that the outcome of the transaction cannot be estimated reliably, although it may be probable that the entity will recover the costs incurred. Thus, Revenue is recognized only to the extent of costs incurred that are expected to be recoverable. As the outcome of the transaction cannot be estimated reliably, no surplus or profit is recognized. 3. Use by others of entity assets. Revenue arising from the use by others of entity assets yielding interest, royalties and dividends or similar distributions shall be recognized when it is probable that the economic benefits or service potential associated with the transaction will flow to the entity, and the amount of the revenue can be measured reliably. Interest. It shall be recognized on a time proportion basis that takes into account the effective yield on the asset. PPSAS 9. Paragraph 35 states that the effective yield on an asset is the rate of interest required to discount the stream of future cash receipts expected over the life of the asset to equate to the initial carrying amount of the asset. Interest revenue includes the amount of amortization of any discount, premium or other difference between the initial carrying amount of a debt security and its amount at maturity. Any accrued interest before the acquisition of an interest-bearing investment. The subsequent receipt of interest is allocated between pre-acquisition and post-acquisition periods where only the post-acquisition portion is recognized as revenue. Royalties. It shall be recognized as they are earned in accordance with the substance of the relevant agreement. Accrued royalties, such as petroleum royalties, are recognized in accordance with the terms of the relevant agreement, unless, having regard to the substance of the agreement, it is more appropriate to recognize revenue on some other systematic and rational basis. Dividends or similar distributions. It shall be recognized when the shareholders or the entity's right to receive payment is established. When dividends on equity securities are declared from pre-acquisition net surplus, those dividends are deducted from the cost of the securities. If it is difficult to make such an allocation except on an arbitrary ratio, dividends are recognized as revenue unless they clearly represent a recovery of part of the cost of the equity securities. Measurement of revenue from exchange transactions. Revenue from exchange transactions shall be measured at fair value of the consideration received or receivable. Fair value is the amount for which an asset could be exchanged, or a liability settled, between knowledgeable, willing parties in an arm's-length transaction. PPASA 23, paragraph 10, provides that agencies may receive trade discounts, quantity discounts or other reductions in the quoted prices of assets for a variety of reasons. These reductions in price do not necessarily mean that the transaction is non-exchange transaction. In which case, IPSAS 9, paragraph 14 to 15 states that any trade discounts and volume rebates allowed by the entity shall be taken into account. Illustration. Entity K is authorized to print accounting manuals for sale to other national government agencies. Assume that on December 27, 2020, Entity K sold accounting manuals on account with a list price of P500,000 less trade discounts of 10%, 10% and 5%. The invoice price of the accounting manuals are computed as follows. List price P500,000 less 10% times 500,000, 50,000, equal to 450,000 less 10% times 450,000, 45,000, equals 405,000, less 5% times 405,000, 20,250. Total P384,750. The journal entry to recognize the sale of accounting manual shall be as follows. Debit. Accounts receivable 384,750. Credit. Sales revenue 384,750. Exchanges of goods or services. When goods or services are exchanged or swapped for goods or services which are of a similar nature and value, the exchange is not regarded as a transaction which generates revenue. However, when goods are sold or services are rendered in exchange for dissimilar goods or services, the exchange is regarded as a transaction which generates revenue. The revenue is measured at the fair value of the goods or services received, adjusted by the amount of any cash or cash equivalents transferred. When the fair value of the goods or services received cannot be measured reliably, the revenue is measured at the fair value of the goods given up, adjusted by the amount of any cash or cash equivalent transferred. Impairment losses and allowance for impairment losses. When an uncertainty arises about the collectability of an amount already included in revenue, the uncollectible amount, or the amount in respect of which recovery has ceased to be probable, is recognized as an expense or impairment losses, rather than as adjustment of the amount or revenue originally recognized. Non-exchange transactions. Revenue from non-exchange transactions are derived mostly from taxes, fines and penalties, gifts, donations and goods in kind. These are received without directly providing something of equal value in return. Taxes. These are compulsory payments intended to provide revenue to the government. Taxes do not include fines and penalties. Fines and penalties. These are monetary sanctions received as a consequence of breach of laws or regulations. Gifts, donations, and goods or services in kind. These are voluntary transfers of assets and services that one entity makes to another, normally free from stipulations. The transferor may be an entity or an individual. For gifts or donations of cash or other monetary assets and goods in kind, the past event giving rise to the control or resources embodying future economic benefits or service potential is normally the receipt of gift or donation. Recognition of revenue from non-exchange transactions. The cash basis of accounting shall be applied by all government agencies in the recognition of revenue from non-exchange transaction until a reliable model of measurement of this revenue is developed. Therefore, asset and the corresponding revenue or liability that arises from non-exchange transaction shall be recognized when collected, or these are legally measurable and collectible. Tax revenue. Taxes are compulsory payments intended to provide revenue to the government. We have different types of taxes that provide revenues for the government. The following are: A. Income tax, which is the earning of assessable income during the taxation period by the taxpayer. B. Value-added tax is the undertaking of taxable activity during the taxation period by the taxpayer. C. Goods and services tax is the purchase or sale of taxable goods and services during the taxation period. D. Customs duty is the movement of dutiable goods or services across the customs boundary. E. Death duty is the death of a person owning taxable property. F. Property tax is the passing of date on which the tax is levied, or the period for which the tax is levied, if the tax is levied on a periodic basis. Taxation revenue. PPSAS 23, paragraph 7 states that taxation revenue shall be determined at gross amount. It shall not be reduced for expenses paid through the tax system. Expenses of the government paid through the tax system or as reduction from tax revenue received should not be offset or deducted from that tax revenue. Therefore, taxation revenue shall be recognized at gross amount, and the expenses deducted shall be recognized and shall form part of the statement of financial performance. Expenses paid through the tax system are those expenses which should be paid irrespective of whether the taxpayer pay taxes or use a particular mechanism to pay taxes. Gifts, donations and goods in kind. Gifts and donations, other than services in kind, shall be recognized as revenue when it is probable that the future economic benefits or service potential will flow to the entity and shall be measured at fair value. Goods in kind received without conditions shall be recognized as revenue immediately. Donation in cash or in kind shall be recognized as revenue. Others. 1. Services in kind not recognized as revenue. 2. Debt forgiveness. In some circumstances, lenders will sometimes waive their right to collect a debt owed by a public sector entity, effectively canceling the debt. For example, a national government agency may cancel a loan owned by an LGU. The LGU concerned recognizes an increase in net assets because a liability it previously recognized is extinguished. Entities recognized revenue in respect of debt forgiveness when the former debt no longer meets the definition of a liability or satisfies the criteria for recognition as a liability, provided that the debt forgiveness does not satisfy the definition of a contribution from owners. Where the controlling entity forgives the debt owed by a wholly controlled entity, or assumes its liabilities, the transaction may be a contribution from owners. PPSAS 23, paragraph 87 states that revenue arising from debt forgiveness is measured at the carrying amount of debt forgiven. 3. Bequest is a transfer made according to the provisions of a deceased person's will. According to PPSAS 23, bequests which satisfy the definition of an asset are recognized as assets and revenue when it is probable that the future economic benefits or service potential will flow to the entity and the fair value of the assets can be measured reliably. PPSAS 23 further provides that the fair value of bequeathed assets is determined in the same manner as for gifts and donations. Bequests are measured at the fair value of the resources received or receivable. 4. Grant with condition. If conditions are attached to a grant, a liability is recognized, which is reduced, and revenue recognized as the conditions are satisfied. If the government is required to recognize a liability in respect of any conditions relating to assets recognized as a consequence of specific purposes, it does not recognize revenue until the condition is satisfied and the liability is reduced. 5. Pledges. Pledges are unenforceable undertakings to transfer assets to the recipient entity. Pledges do not meet the definition of an asset because the recipient entity is unable to control the access of the transferor to the future economic benefits or service potential embodied in the pledged item. Agencies do not recognize pledged items as assets or revenue. If the pledged item is subsequently transferred to the recipient entity, it is recognized as a gift or donation. Pledges may warrant disclosure as contingent assets. 6. Concessionary loans. These are loans received by an entity below market values. According to PPSAS 23, paragraph 105, an entity considers whether any difference between the transaction price, loan proceeds, and the fair value of the loan on initial recognition is non-exchange transaction. When an entity determines that the difference between the transaction price, loan proceeds, and the fair value of the loan on initial recognition is non-exchange revenue, an entity recognizes the difference as revenue, except if a present obligation exists. Where a present obligation exists, it is recognized as liability. As the entity satisfies the present obligation, the liability is reduced and an equal amount of revenue is recognized. Other receipts. Subsidy from national government and other national government agencies recognized as revenue from assistance and subsidy. Receipts from excess cash advance. Overpayment of expenses. Performance bonds and security deposits collections on behalf of other entities. And inter- or intra-agency fund transfers. These kinds of receipts are not recognized as revenue. That ends our lesson. Thank you for watching. Please don't forget to subscribe for more videos.